Welcome to the Pro Ticker Deep Dive.
It's great to be back.
Usually when we sit down to dissect an earnings report, we're looking at spreadsheets. We're looking at margins, EPS, all the dry stuff.
The fundamentals.
The fundamentals. But today feels different. We're looking at a report that just dropped on February 3rd, 2026. This is PepsiCo's Q4 2025 earnings, and it feels less like a financial update and, more like a cultural referendum.
That is the perfect way to frame it. I mean, this isn't just about whether Pepsi sold enough soda last quarter.
Right.
This is about whether the entire business model of big snacking is hitting a wall. We're talking about a company at a massive strategic crossroads. They're trying to navigate a consumer who is, frankly, stretched thin by years of inflation.
It's easy stretch.
And now, on top of that, they're facing this biological headwind we've just never seen before with the rise of GLP-1 weight loss drugs.
And if that wasn't enough, you've got the sharks circling in the water.
Yeah.
Activist investors.
Right. So the mission for this deep dive is to really look past the headline numbers. We need to unpack how a legacy giant, a true icon, tries to reinvent itself in real time.
So what's the plan?
We're going to dissect what we're calling the earnings paradox, then look at the aggressive, and I mean really aggressive new strategy involving price cuts and product purges.
And then the health angle.
And then we have to analyze this fascinating health pivot.
And we can't ignore the battle with Coca-Cola because, well, the scorecard there is looking very, very lopsided right now.
Yeah, it really is.
But let's start with the immediate news. It's February 2026. The report is out. If you just glanced at the headlines on your terminal, you would think PepsiCo was having a party.
On the surface, an absolute victory lap. They beat expectations, and, Wall Street loves a beat.
Always.
PepsiCo reported Q4 revenue of $29.34 billion. Now, that's up 5.6% year over year.
And the estimate was what, around $29 billion?
The analysts were sitting around expecting $29 billion flat, maybe a hair under. So finding an extra $340 million in revenue it's significant.
Yeah. That is not pocket change. That is the GDP of a small island nation right there in the beat.
Exactly. And it flowed down to the bottom line, which is what really matters for investors in the short term. Earnings per share, or EPS, hit $2.26.
And the forecast was?
The forecast was $2.24. So top line beat, bottom line beat. The stock even popped about 5% right after the announcement.
So on announcement day, investors saw green and exhaled. A sigh of relief.
A huge sigh of relief. But you and I know that the stock market has a really short attention span. When you actually open the report and look at the health of the business metrics, specifically volume, well, the story changes completely.
It's like the music stops.
It turns into a red alert. This is the earnings paradox we're talking about. You have revenue going up, but the actual amount of product leaving the warehouse, the organic volume, is down. Globally, food volume fell 2%.
And just to clarify for everyone listening, organic volume means they sold 2% fewer physical units.
Yeah.
Like literally fewer bags.
Correct. And that's the global number. If you zoom in on their profit engine, which is PepsiCo Foods North America, that's Frito-Lay and Quaker, the volume declines are stark, really stark.
And beverages.
North American beverages, down 4%.
4%. So, doing the simple math here, if I'm selling 4% fewer bottles of Pepsi and 2% fewer bags of Lay's, but my overall revenue is up 5.6%, there's only one lever that makes that equation work.
Pricing. It's all pricing. They charged the customer significantly more for each item. Their effective net pricing was up 4.5%.
Which explains the revenue bump completely. But it feels so artificial, doesn't it? It's the classic pay more for less strategy.
It works until it doesn't, and that's the key. For the last 3 years, maybe 4, companies relied on what they call pricing power. Inflation was everywhere, so consumers just sort of grumbled and paid the extra dollar.
It was expected.
Right. But PepsiCo hit the wall, it seems, in late 2025. We call it demand destruction.
The rubber band snapped.
It snapped hard. Management used this very specific word in the earnings call, and, they choose these words carefully. They said consumers are becoming choiceful.
Choiceful.
Yeah.
I love corporate euphemisms. That translates to, I am looking at this $7 bag of Doritos, I am looking at my bank account, and I am walking away.
Or I'm walking 2 feet to the left and buying the store brand for $3.50, and that is the danger zone for a brand like PepsiCo.
Why is that so dangerous?
Because if you lose a customer to a generic brand because of price, you might get them back when they feel richer. But if you lose them because they just decide snacking isn't worth the cost anymore, that habit might be gone for good.
So this beat on the earnings is actually masking a much deeper crisis of loyalty and affordability.
Precisely. The old playbook of just raise prices to beat inflation. It's dead. It is over. And PepsiCo knows it. They have to know it.
Which brings us to the new reality. They aren't just tweaking the dials anymore. They are, it seems, performing major surgery on the entire business model.
Yeah, you can't just put a Band-Aid on this.
So let's get into that surgery. This is our second section, the surgical strike. Because this isn't just management waking up one day and deciding to change course on a whim.
No.
They have a new partner in the boardroom, effectively.
Oh.
A very loud, very influential partner.
Enter Elliott Management.
The activist investors. For those who don't follow the high drama of Wall Street hedge funds, Elliott is not the kind of investor who buys stock and sends a nice holiday card.
No. When Elliott buys a stake, and we're talking about a $4 billion stake in PepsiCo in late 2025, they show up with a slide deck and a list of demands.
They're not making suggestions?
No, they're essentially the high-priced consultants who fire the other consultants. They are incredibly rigorous, and they pointed out a statistic that must have been, frankly, humiliating for PepsiCo leadership.
What was the stat?
They noted that PepsiCo had 70% more distinct products, what we call SKUs or stock-keeping units, than Coca-Cola.
70% more.
70% more stuff to sell. But, and here's the kicker, their retail sales were 15% lower.
Wait, let me wrap my head around that. They are manufacturing, packaging, shipping, and stocking nearly double the variety of products, but making significantly less money than their main rival.
It is the dictionary definition of inefficiency. It means their supply chain is just clogged with products that nobody is buying.
The complexity tax.
That's it. It's what we call the complexity tax. Every weird flavor, every niche package size, every limited edition that just sits on a shelf is costing them money to store and track and manage.
So Elliott walks in and says, clean house.
And Pepsi is listening. This leads to Strategy A SKU rationalization, or as I like to call it, the purge.
The purge.
By early 2026, so right now as we're speaking, PepsiCo is executing a plan to cut nearly 20% of its unique product lines in the U.S.
1 in 5 products is getting the axe. That is massive. Are we talking about losing the core stuff? Is my Cool Ranch Dorito safe? Tell me my Dorito is safe.
The core is safe, don't worry. They aren't killing the cash cows, they're killing the zombie SKUs.
Zombie SKUs.
This spicy dill pickle remix that sells 1 unit a week in a store in rural Ohio. The weird 12.5-ounce bag that confuses the shopper because it sits right next to the 13-ounce bag. They're just trying to declutter the shelf.
Which makes sense from a shopper's perspective. If I'm staring at a wall of 400 options, I get decision paralysis. I might just walk away.
Exactly.
If you curate it down to the best 50, I might actually buy more.
That's the theory. Simplicity drives velocity. But cleaning up the shelf is only half the battle. You still have to solve the price issue we talked about.
The affordability.
Right. And this is where PepsiCo is doing something pretty risky. Strategy B, the price investment.
Which is a fancy corporate way of saying price cuts.
Significant price cuts. We're seeing data that they are rolling back prices by up to 15% on specific key snacks.
And which ones are we talking about?
The big boys. Lay's, Tostitos, Doritos, Tito's, the Mount Rushmore of snacking.
15% is a huge haircut on revenue for your biggest brands. If that bag was, say, $6, they're knocking almost a full dollar off the price.
It's huge. Management is framing this as playing offense. They've realized that for the low to middle income consumer, who is their bread and butter, the price tag had become a source of friction.
A barrier.
A huge barrier. It wasn't fun to shop for snacks anymore. It was stressful. They're trying to remove that friction.
But here's the gamble, and correct me on the math here. If I cut my price by 15%, I don't just need to sell 15% more bags to break even, do I? Because my profit margin on each bag takes a huge hit.
Correct. The volume hurdle is incredibly steep. You need to sell significantly more volume just to make the same amount of profit dollars. It is a pure volume play.
So they're betting that the lower price will drive so much traffic and so many more sales that it overwhelms the margin loss.
That's the bet, a multi-billion-dollar bet.
Is it working? What are the early signs?
Early tests say yes. They are projecting double-digit shelf space gains in the upcoming spring resets at major retailers.
And why is that?
Retailers love it. They love it because when prices drop, inventory moves. The worst thing for a grocery store is a bag of chips that expires on the shelf. That's a total loss. So they'll give more space to the brands that are moving.
Now, to pay for all these price cuts, they have to be saving money somewhere else. You can't just slash revenue without slashing costs, or Wall Street will crucify you.
Mm-hmm.
I read something about operational integration, merging trucks.
This is the unsexy plumbing that makes the whole business work, or in this case, didn't work so efficiently.
Goes the old model.
Historically, PepsiCo has run two separate empires. One giant fleet of blue trucks for the beverages, and a totally different fleet of, Frito-Lay branded trucks for the snacks.
Which, when you say it out loud, just sounds ridiculous. They're going to the same Walmart, the same Kroger.
It does, but there's a physical reason for it.
Yeah.
Soda is heavy, it's dense, it's durable, you can stack it high, chips are light, they're bulky, and they're incredibly fragile. You can't just stack a pallet of Pepsi on top of a pallet of Tostitos. You'll end up with tortilla dust.
Right, you'll have chip crumbs before they even get to the store.
But under pressure from Elliott and the absolute need to fund these price cuts, they are now testing integrated distribution in Texas and Florida.
So one truck, one invoice, one drop-off at the retailer.
Exactly. If they can figure out the logistics, how to pack the truck so the chips survive the journey, the savings are just astronomical. Less fuel, fewer drivers, fewer warehouses. That efficiency is what pays for the cheaper Doritos.
Okay, so that covers the economic pivot, fix the price, fix the supply chain. But there is a bigger, scarier variable in the equation. We touched on it in the intro, but let's dive in. The I'm not hungry consumer. Section 3, the GLP-1 factor.
This is the tectonic shift. We are moving from the world of economics to the world of biology.
We've been hearing about Ozempic and Wegovy for a few years now. It's all over the news. But is it really hitting the bottom line of a snack company? Or is this just media hype?
It is absolutely not hype. The adoption curve is real and it's steep. And the behavioral data that's coming out is, well, it's startling. Morgan Stanley did a deep research dive on this.
And what did they find?
They found that 66% of GLP-1 users, 2/3, reduce their snacking frequency.
2/3. Just stop snacking as much.
And it gets worse for PepsiCo. 74% of users actively avoid fatty foods.
That is, well, if your name is Frito-Lay, that is an existential threat. Fatty foods is basically your business description.
It is. It's a direct hit. Because these drugs don't just make you feel full in the traditional sense. They actually turn off what neurologists call the food noise.
Food noise. Explain that.
You know that feeling when you're stressed or bored and you just need a salty crunch? That dopamine craving that drives you to the pantry? These drugs mute that signal in the brain. It's a neurological reset. Biology is telling consumers, enough. You don't need that.
So the old marketing slogan, a brilliant slogan, bet you can't eat just one, is now being chemically rewritten in the brain to, actually, I don't want any.
Exactly. So how does PepsiCo respond to that? You can't market your way around a molecule. You can't just run a fun Super Bowl ad. You have to pivot the entire portfolio.
So what's the new strategy?
They're moving from a strategy of defending junk food to a strategy of permissibility and functionality.
Permissibility. I hear that word a lot in the industry now. It sounds like I need a hall pass to eat a chip.
In a psychological sense, you do. If you're health conscious, or especially if you're on these medications, you need a rationalization to eat something. You need the food to do something for you. So Pepsi is focusing on what they call nutrient density.
So moving away from empty calories.
Moving from empty calories to things with fiber, protein, whole grains.
Okay, give me the concrete examples. What does a nutrient-dense Pepsi products look like in the real world in 2026?
Okay, start with hydration. This is a big one. They are completely restaging Gatorade.
How so?
It's no longer just sugar water for athletes after a game. They're pushing low-sugar versions, zero artificial sweeteners, and heavily marketing the electrolyte powders and tablets.
Which aligns perfectly with the GLP-1 users, right? One of the big side effects is dehydration. You need electrolytes.
Exactly. They are positioning Gatorade as a clinical hydration tool, not just a sports drink. It's a brilliant pivot. Then look at the food. Doritos protein.
Doritos protein. I have to admit that sounds a bit dystopian. What is it really?
It's likely a formulation using something like pea protein or maybe dairy protein isolates mixed directly into the corn dough. The goal is to get the protein count up high enough that when you eat a handful, you can tell yourself, I'm getting my protein macro, rather than just, I'm eating empty carbs.
It changes the narrative of the snack. It gives you an excuse.
It gives you permission.
Right.
And then you have the simply NKD line. NKD.
Which I assume means naked, not some new complex acronym.
Right, naked. This is for Cheetos and Doritos. Absolutely no artificial flavors, no artificial colors, no red dye 40.
Who is that for?
This targets the parent or the adult snacker who wants the nostalgia and the taste of a Cheeto, but has read too many articles about artificial ingredients. It's the clean label play. It's about removing the negatives.
But the one that really caught my eye in the notes was Pepsi Prebiotic.
Ah, yes, the healthy soda.
We've seen these other brands like Poppy and Olipop just explode onto the scene. Pepsi finally decided to make their own.
They did, and the launch was incredible. They did a limited drop on Black Friday. It sold out in 30 hours.
Gone.
Completely gone. That signals massive pent-up demand. People want the soda experience, the cold can, the fizz, the taste, but they want it to be productive for their body. It helps my gut. They are now rolling that out to national distribution.
And they aren't just building it themselves, they're buying their way into this new world too.
Right. Smart companies do both. They acquired Siet Foods.
I love Siet. The grain-free chips, the tortillas, they're great.
A huge acquisition. It gives them an immediate, authentic foothold in the paleo, gluten-free, anti-inflammatory crowd. These are customers who would never touch a bag of Lay's.
And Poppy.
And they're integrating Poppy, the prebiotic soda, which saw its retail sales jump 45% last year alone.
So the strategy is essentially, we want to sell you snacks and drinks. Ideally, we sell you a bag of classic Lay's. But if you're on Ozempic and you won't touch Lay's, we will sell you Cete chips. If you won't drink a classic Pepsi, we will sell you a prebiotic soda.
It's a share of stomach play. Even if the stomach is shrinking, PepsiCo wants to own whatever goes into it.
It is a smart survival strategy.
Mm-hmm.
It has to be. But while Pepsi is scrambling to pivot its entire identity, we have to look across the aisle at the red giant. Section 4, the Cola Wars. Because right now, Coke seems to be playing a different game entirely.
This is the divergence that is driving Pepsi investors absolute crazy. If you held Coca-Cola stock in 2025, you were up about 11%. A very solid year.
And Pepsi.
If you held Pepsi, you were essentially flat or even down, depending on exactly when you bought. A huge underperformance.
Why the big split? They're the twin titans of the industry. They usually move more or less together.
It comes down to a structural difference. Coca-Cola is a pure play beverage company. They don't sell chips. They don't sell oatmeal. They sell liquid. And they have a global distribution network that is simply unrivaled.
And Pepsi is the hybrid, the 50-50 company.
Pepsi is roughly 50-50 snacks and drinks. And right now, in this environment, the snack business Frito-Lay is the anchor dragging the whole ship down.
Why is that?
Because inflation hit the grocery aisle much harder than it hit the gas station cooler or the movie theater fountain.
The away-from-home market. Coke has that dominance. Theme parks, restaurants, stadiums.
Exactly. People are much less price sensitive when they're at a baseball game buying a Coke for $6 than when they are at Kroger doing their weekly shop and staring at that $7 bag of chips.
So Coke's volume held up better because of where it is sold, not just what it is.
Precisely. And Coke didn't have the CQ problem that Pepsi had. They didn't have that complexity.
So they run leaner.
They run much leaner. So the market is valuing them higher. Right now, Coke trades at a price-to-earnings ratio, a PE ratio of about 22 times forward earnings.
And Pepsi is trading at a discount.
A significant discount, around 17 times forward earnings.
And just for the listener, that PE ratio is basically how much investors are willing to pay for every dollar of profit a company makes. They're willing to pay $22 for a dollar of Coke's profit, but only $17 for a dollar of Pepsi's profit. That's a real confidence gap.
It is. But that brings up the big opportunity, the bull case for Pepsi. Is Pepsi a value trap, meaning it's cheap because it's fundamentally broken, or is it simply on sale?
The classic contrarian bet.
Right. If you believe in this turnaround, if you believe these price cuts will bring the volume back and the protein chips will win over the Ozempic crowd, then Pepsi stock at 17x earnings is a steal.
Because it has room to grow.
It has significant upside potential to re-rate closer to Coke's valuation.
So Coke is the safe, steady bet. Pepsi is the high-risk, high-reward show-me story.
Exactly. Pepsi is the turnaround story of 2026.
Okay, so let's look at what they're actually promising for that turnaround. Section 5. The outlook and guidance. They gave us numbers for 2026. What do they look like?
They're being cautious. The phrase I'd use is cautiously optimistic.
The classic corporate stance.
Of course. For the full year 2026, they are guiding for organic revenue growth of 2% to 4%.
2 to 4%. It's lukewarm. It's not setting the world on fire.
It is not a rocket ship. But crucially, they made a point to note they aim to be at the high end of that range in the second half of the year.
The classic second half recovery. It's always just around the corner, isn't it?
It always is.
Why do they think the second half will be better? What's the logic there?
It's about mechanics, the price cuts we talked about. They take time to filter through the system. You cut the price on the wholesale side in February. Maybe the shopper sees that new price tag in March. The habit starts to reform by May or June.
And the new products.
And the restaging of Lay's and Gatorade, the new packaging, the new marketing push, that all really kicks into high gear during Q2 and Q3.
And what about profit growth?
Core EPS growth is expected at 4% to 6% on a constant currency basis. Again, solid, steady, but not explosive growth.
But in the meantime, they did throw a bone to the shareholders to keep them patient while this all plays out.
A pretty big bone, actually. They announced a dividend increase of 4%. That raises the annual payout to $5.92 per share.
And why does that matter so much?
Because it marks the 54th consecutive year of dividend increases. That keeps them in the elite club called the Dividend Kings.
A very exclusive club.
Very, and it signals stability. It tells the market, look, we know things are tough, but we have enough cash flow to pay you no matter what happens with the chips. It's a message of strength.
And they're buying back their own stock too, right?
A new $10 billion share repurchase program has been authorized, running through 2030. They expect to spend about $1 billion buying back their own stock just in 2026.
Which essentially puts a floor under the stock price. If the stock drops too low, the company itself steps in and becomes a buyer, creating demand.
It's a confidence mechanism, pure and simple.
I want to ask about the mood in the C-suite. Ramon Laguarta, the CEO. When he was on the earnings call, what was his tone? Did he sound panicked? Defensive?
Panicked is too strong. He sounded urgent. The phrase he kept using over and over was a heightened sense of urgency.
That is definitely corporate code for "we are sweating."
It is code for we know the old trick stopped working and we're on it. He wasn't dismissive. You know, sometimes you hear CEOs blame the weather or a calendar shift or some other external factor.
Right.
He didn't do that. He acknowledged that the consumer has changed and changed fundamentally.
What are the big risks to this whole turnaround plan? What could go wrong?
Well, the supply chain is always one. If a conflict in the Middle East spikes oil prices, shipping costs go up, and that completely kills the margin they are trying to protect with the efficiency gains.
Geopolitics.
Right. They also mentioned China is a mixed market right now, which is a big variable. But the biggest risk, I think, is the one we started with, the private label issue.
The store brands.
Will the customers actually come back? Once you realize that the Kroger brand corn chips are 90% as good as Fritos but 40% cheaper, do you ever switch back? Even if Fritos drops their price by 15%, the gap is still significant.
It's about breaking the habit.
Exactly. Brand loyalty is incredibly hard to build over decades, but it's very, very easy to lose in a matter of months.
And once you break that habit, it's expensive to get them back.
Very expensive. That is why they're spending billions on this reset.
So let's try to wrap this all up. We've covered a lot of ground here, from pricing strategy to brain chemistry. If we have to boil PepsiCo's 2026 survival guide down to 3 words, what would they be?
The strategy really sits on 3 pillars. I'd call them the 3 A's. First is affordability.
The price cuts.
That's the price cuts. Getting the value equation right so people can buy your product without feeling guilty. Second is availability.
The shelf space.
That's the SKU rationalization and the supply chain work. Making sure the right products are on the shelf, easy to find, and not cluttered with zombies. And third, and maybe most important now, is acceptability.
The health pivot.
That's the health pivot. Changing the ingredients, adding protein, removing artificials, so that in this new GLP-1 era, the consumer feels okay saying yes to the snack.
Affordability, availability, acceptability. It's a clean framework. It makes sense.
It's a solid plan on paper, but as they say, execution is everything.
So here's the big question I want to leave our listeners with today. We've watched PepsiCo dominate this industry for decades. They are an American icon. Is this moment just a temporary stumble for a legendary company, a blip on the radar that they'll correct? Or are we witnessing the beginning of a permanent decline for the entire big snack model?
That really is the billion-dollar question, isn't it? Can a giant learn to dance before the music stops for good?
And I'll add one final provocative thought for you to chew on. We talk about marketing, we talk about price points, we talk about distribution. But when biology, literally the chemistry in your brain, turns off the fundamental craving for salt and sugar, can a company built on the slogan, "Bet you can't eat just one," actually survive by selling protein chips and functional water?
It's an existential threat unlike any they've ever faced. Can you market your way around biology? I'm not so sure.
The next 12 months are going to decide the winner of the snack aisle, and we will be watching.
We certainly will.
Thanks for listening to the Pro Ticker Deep Dive. We will see you next time.